Welcome back to Marginal Thoughts.
Great to be here.
Ever feel like Wall Street is speaking, I don't know, a secret language?
Yeah, it can definitely sound that way sometimes.
Well, today we're trying to hand you a bit of a decoder ring for one of the most common phrases you hear, the S&P 500.
Yes, the S&P 500. You hear it all the time on the news.
Exactly. But what is it, really? And maybe more importantly, how can understanding it actually, benefit you, even if you're totally new to investing?
Okay, let's break it down.
Uh,
At its heart, the S&P 500 is an index.
an index, okay.
Yeah, think of it like a carefully chosen list. It represents 500 of the largest companies in the U.S. whose stock is publicly traded.
Largest, okay. So like the big names we all know.
Many of them, yes. When you hear about the S&P 500 going up or down, you're essentially getting a snapshot, a feel for how a very large chunk of the U.S. economy is doing.
So it's like a big economic indicator then, taking the pulse of U.S. business.
Precisely. A really broad pulse check.
Now, it's not just 500 companies picked at random, is it? You mentioned size matters.
Absolutely. It's what we call market value weighted or market cap weighted.
Market value weighted. Explain that a bit.
Sure. Imagine all the companies on a big scale. The bigger the company's total value in the stock market, that's its share price, times all its shares out there, the more weight it has on that scale.
Ah, okay.
So the giants, Microsoft, Apple, Nvidia, Amazon, Meta, companies like that, their movements, up or down, have a much bigger influence on the index's overall performance compared to the smaller companies within that 500.
I see. Like looking at one of those heat maps where the size of the square shows the company's weight.
That's a perfect analogy. Yes, exactly like that. Bigger square, bigger impact.
And this list of 500, it's not set in stone forever, right?
Not at all. It's dynamic. Companies can get added, others can get dropped based on changes in their market value and some other criteria.
So it evolved.
Yeah, it has to stay relevant. It's kind of amazing. The index itself was launched way back in 1957.
Wow, 1957.
Yeah, long before many of the companies currently in the index even existed.
That's wild. So, okay, it's this important evolving benchmark for the U.S. stock market. But let's bring it back to someone just starting out. Why should they care? What's the real benefit for a beginner?
Right. This is key. For beginners, the S&P 500 offers, honestly, a remarkably simple way to start investing.
Simple how? Investing often sounds complicated.
Well, instead of facing the, frankly, pretty overwhelming task of researching and picking individual stocks, which, let's be honest, is tough.
Yeah, that sounds intimidating.
You can invest in one single thing, like a fund, that automatically holds pieces of all 500 of these major companies. It takes the guesswork out of picking stocks.
Okay, so you buy into the whole group at once.
Exactly. Even Warren Buffett, arguably one of the greatest investors ever, has famously recommended this approach for most everyday people.
Okay, if Buffett says it, that carries some weight. So simplicity is a big plus. What else?
Diversification. That's another huge one for beginners.
Diversification, meaning not putting all your eggs in one basket.
Precisely. When you invest in an S&P 500 fund, your money isn't just riding on the success or failure of one or two companies. It's spread out across all those 500 companies, which themselves are spread across lots of different sectors of the economy. Technology, healthcare, finance, consumer goods, you name it. Remember that heat map?
Yeah.
It's like investing in the whole map, not just one tiny square.
Yeah.
So if one company, or even one whole sector, has a rough patch, it doesn't necessarily sink your entire investment. It cushions the blow.
Okay, that makes sense. Built-in safety net, almost.
Kind of, yeah. And then there's the historical performance. Over the long term, the S&P 500 has shown pretty strong returns.
How strong are we talking?
Historically, the average annual return, if you include reinvested dividends, has been around 10%. Some analyses, looking back even further, like last century, put it closer to 12% on average per year.
12% average over 100 years. That's quite something.
It really is. Now, past performance isn't a guarantee of future results, obviously, but it's a compelling track record.
Definitely gives you context.
And think about that Buffett bet again. He wagered that a simple, low-cost S&P 500 index fund would outperform a selection of actively managed hedge funds over 10 years.
Oh, it happened.
The S&P 500 fund won handily. It returned something like 125.8% over the decade, while the hedge funds he bet against had returns ranging from just 2.8% to about 87.7%.
Wow. So the simple approach beat the pros trying to be clever.
In that case, yes. It really highlights the power of just tracking the broad market sometimes.
Okay, simplicity, diversification, strong history. Any other reasons this is good for someone starting out?
Well, there's also inflation to consider.
Ah, yes. The value of money decreasing over time.
Exactly. Inflation eats away at the purchasing power of your cash. If money's just sitting in a savings account, especially lately, it's likely losing value in real terms.
Right.
Investing in something like the S&P 500, which represents productive businesses, gives your money the potential to grow faster than inflation, helping protect and hopefully increase your buying power over the long run. Idle cash just doesn't do that.
Okay, I'm sold on the why. It makes a lot of sense. So the big question, how does a beginner actually invest in this thing? Do I need to call 500 different brokers?
Uh-huh. Definitely not. That would be a nightmare.
Yeah.
No, the easiest way is through something called an exchange-traded fund, or ETF.
ETF. Heard of those.
Right. So an S&P 500 ETF is basically a fund that holds stocks of all, or nearly all, the companies in the S&P 500 index,
Yeah.
in those same proportions we talked about, that market weighting.
Okay.
And the key part is exchange-traded. It means you can buy and sell shares of this ETF on a stock exchange,
True.
just like you would buy or sell shares of Apple or any other single company.
So one transaction gets me a tiny piece of all 500.
Exactly. You buy one share of the ETF, you own a slice of the whole index.
That sounds much easier.
It is. And here's something else that's fantastic for beginners. Fractional shares.
Fractional shares.
Yeah. Many brokers now let you buy less than one full share of an EPF or stock. So if one share of an S&P 500 ETF costs, say, $500, you don't need $500 to start.
You don't.
Nope. You can invest just $10 or even $1, and you'd own a corresponding fraction of that share.
Seriously, $1. That basically removes the I don't have enough money excuse.
Pretty much. It makes it incredibly accessible.
Okay, so I can buy small bits using ETFs, but when should I buy? Do I wait for the market to dip? Try to time it?
Ah, the timing question. Look, trying to time the market perfectly is notoriously difficult, even for professionals. A really good strategy for beginners, and honestly for many investors, is dollar cost averaging.
Dollar cost averaging. Okay, what's that?
It just means investing a fixed amount of money at regular intervals, say $100 every month or $25 every week. You invest that same amount, whether the market is up, down, or sideways.
Regardless of the price.
Exactly. When the price is lower, your fixed amount buys more shares. When the price is higher, it buys fewer shares. Over time, this averages out your purchase price and reduces the risk of investing a large sum right at a market peak.
Takes the emotion out of it too, maybe.
Definitely helps with that. It encourages discipline and consistency, which are crucial for long-term investing.
Okay, consistent investing. Got it. You mentioned dividends earlier too.
Right. Many companies in the S&P 500 pay out a portion of their profits to shareholders. These are dividends.
Little cash payments.
Yeah. And most brokerage accounts let you automatically reinvest those dividends.
How does that work?
Instead of the cash landing in your account, it's automatically used to buy more shares or fractional shares of the same S&P 500 ETF.
Ah, so the investment starts feeding itself.
Precisely. It's a key part of compounding.
Yeah.
Your dividends buy more shares, which then earn more dividends, which buy even more shares. It creates a snowball effect over time.
Nice. Okay, are there specific ETFs for the S&P 500 that people usually start with? Ticker symbols, maybe?
Sure. Three of the biggest and most popular ones are Vanguard's S&P 500 ETF, ticker symbol VOO.
VOO.
Then there's the iShares Core S&P 500 ETF, ticker IVV.
IVV, got it.
And the SPDR S&P 500 ETF Trust, ticker SPY.
SPY, that one sounds familiar.
Yeah, SPY is actually the oldest ETF and technically structured a bit differently as a unit investment trust. But for practical purposes for most investors, it tracks the S&P 500 just like VOO and IVV.
Okay, VO, IVV, SPY. Is one better than the others for a beginner?
They all do a very good job of tracking the index, so their performance is usually almost identical. One key thing to look at, though, is the expense ratio.
Expense ratio. Sounds like a fee.
It is. It's the annual fee the fund manager charges to run the ETF, expressed as a percentage of your investment.
And lower is better.
Absolutely. Especially for long-term investing, even small differences in fees can add up significantly over time. Vanguard's VOO, for example, is known for having a very, very low expense ratio, often around 0.03%.
0.03%. That sounds tiny.
It is tiny. Compare that to maybe an average actively managed mutual fund where fees could be closer to 0.79% or even higher.
Wow. Okay. So VO might have an edge there on fees.
It often does, yes. IVV is usually very low, too. SPYs might be slightly higher than VOO or IVV, but still relatively low compared to active funds. The main takeaway is always check the expense ratio. It matters.
Good tip. Keep fees low. Now let's talk more about that snowball effect you mentioned, compounding. How powerful is it really?
Oh, it's incredibly powerful. Einstein supposedly called it the eighth wonder of the world. It's basically your money, and then that money making more money.
Growth building on itself.
Exactly. The S&P 500, with its historical tendency to grow over the long term, provides the fuel for that compounding engine.
Can you, paint a picture, maybe with numbers?
Sure. Let's use that 10% average annual return, just for illustration. Imagine you start with nothing, $0, but you invest $500 every single month into an S&P 500 ETF.
Okay, $500 a month.
After 10 years, investing $60,000 total, $500 by 12 months by 10 years, your investment could potentially grow to nearly $100,000. So about $40,000 of that is growth.
Nice chunk of growth in 10 years.
Right. Now, keep doing it for another 10 years, so 20 years total. You've invested $120,000. You might think you'd have around $200,000, right? Double the first 10 years.
Seems logical.
But because of compounding, it could actually be closer to $350,000.
Whoa. Okay, that's accelerating.
It really picks up steam. Now, let's go out 30 years. You've put in $180,000 total over those 3 decades, your investment. Potentially over $1 million. And by that point, the vast majority of your balance is actually from investment gains, not your contributions.
$1 million from $500 a month. That really shows the power of starting early and being consistent.
It's all about time in the market and letting that compounding work its magic.
Okay, this sounds great. Almost too easy. Are there, catches, things beginners absolutely need to watch out for? Pitfalls.
Yes, definitely things to be aware of. First, taxes.
Always taxes.
Right. How your investment gains are taxed depends on the type of account you use. If you invest in a regular taxable brokerage account,
Like just a standard investment account.
exactly, you'll likely owe taxes on any dividends you receive each year. And when you eventually sell your ETF shares for a profit, you'll owe capital gains tax on that profit.
Okay. Are there ways around that?
Well, not around taxes completely, but tax-advantaged accounts can help significantly. Retirement accounts like a Roth IRA are very popular.
A Roth IRA.
Yeah. With a Roth, you contribute money you've already paid income tax on. But then, your investments inside the Roth IRA can potentially grow completely tax-free.
Tax-free growth.
Yes. And if you follow the rules, your qualified withdrawals in retirement are also tax-free. It can be a huge advantage over decades of investing.
Wow. Okay, so choosing the right account type is important. What about mistakes people make while investing in the S&P 500?
A common one is trying to time the market by investing a large lump sum all at once.
Putting all your money in on one day.
Yeah. If you happen to do that right before the market drops, it can feel pretty bad and might scare you off investing. That's why dollar cost averaging is often recommended. It smooths out your entry points.
Avoids that buy high regret.
Exactly. Another huge pitfall is emotional reacting, especially panic selling when the market goes down.
Seeing your balance drop and hitting the sell button.
Yes. It's completely understandable emotionally, but historically it's often the worst thing to do. Market downturns are a normal part of investing. If you have a long-term horizon, those dips can actually be opportunities to buy more shares at a lower price, selling low locks in your losses.
So stay disciplined, stick to the plan.
That's the key. And related to that, ignoring those fees we talked about.
Yeah.
Even small expense ratios add up over time, so pay attention to them. Don't let high fees eat away at your returns unnecessarily.
Right, keep costs low. Anything else risk-wise? Is the S&P 500 itself risky in any way?
Well, all stock market investing involves risk. One thing to be aware of with the S&P 500 is concentration risk.
Concentration? I thought it was diversified across 500 companies.
It is, which is great.
Yeah.
But remember the market value weighting. The biggest companies make up a pretty significant chunk of the index. Like the top 10 holdings might be close to 30% of the entire index's value.
So you're still heavily influenced by just a few big players.
To some extent, yes. Recently, we've seen a lot of the index's growth driven by a handful of very large tech-related companies, sometimes called the Magnificent Seven.
Huh. Heard of them? Apple, Microsoft, NVIDIA, etc.?
Right. So if those specific companies were to stumble, it would have a noticeable impact on the S&P 500, more so than if some smaller companies stumbled. It's something to be aware of, this increasing concentration.
Does that mean it's not really diversified anymore?
Oh, no, I wouldn't say that. For a beginner, it's still vastly more diversified than trying to pick just 5 or 10 individual stocks yourself, but it's not perfectly diversified, and its performance can be heavily influenced by its largest components. And of course, there's general market risk.
Meaning the whole market can go down.
Exactly. Economic downturns, changes in interest rates, geopolitical events, lots of things can cause the entire stock market to decline, and the S&P 500 will generally move with the overall market. It's not immune to broad market swings.
Okay. And watch out for things that sound diversified but aren't.
Yeah, that's a good point, too. There are lots of niche ETFs out there focusing on specific sectors or themes. While they might hold many stocks, they might not provide the broad diversification you get from something like the S&P 500. They could actually be concentrating your risk in one area. So know what you're buying.
Makes sense. Understand what's actually in the ETF.
Always.
This has been incredibly helpful. It really feels like we've peeled back the curtain on the S&P 500. It sounds like, despite the jargon, it's actually a very accessible and potentially powerful starting point for anyone looking to build long-term wealth.
I absolutely agree. It offers that blend of simplicity, diversification, and a connection to the growth of the broader U.S. economy that's hard to beat, especially for someone just getting started. It demystifies a big piece of the investing puzzle.
So we've unpacked the S&P 500, showing how it can be a really valuable tool for anyone ready to begin their investment journey.
Yeah, it's definitely not as intimidating as it first sounds.
And just understanding the basics can really put you on a better path towards long-term financial growth. Now, we'd love to hear from you. What are your initial thoughts after hearing this? Does investing in the S&P 500 feel more achievable now?
Or what questions do you still have? Maybe something we didn't cover.
Exactly. Share your insights, your questions, anything down in the comments below. We're all learning here together.
Definitely.
And if you found this explanation useful and you want to help demystify other parts of the financial world with us,
We'd appreciate it.
then please make sure to subscribe to Marginal Thoughts so you don't miss our future explorations. Your support really does help us keep bringing these insights to you. Thanks for tuning in.
Thanks, everyone.